This is TreppWire Week in Review for week ending December 3rd. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, the first U.S. case of the COVID variant Omicron threw fuel into an already volatile market. And in comments to the Senate, Fed Chair Powell said it may be time to speed up the taper. In economic data, holiday shopping dropped as more people shopped earlier. Air travel surged over the holiday weekend with the highest numbers since February 2020. Jobless claims came in at levels consistent with pre-pandemic times. And November consumer sentiment fell to the lowest level in 9 months because of inflation concerns. Manus, we've seen a wild market swing this week. What is driving today's rebound?
Well, I think there's been two things that have really dominated the news cycle. The first, on Black Friday, we saw the new COVID-19 variant discussed for the first time in the news. That led to a really, really painful sell-off. By Monday, I think people thought that was an overreaction. By Wednesday, we heard that the first case in the US had hit California. I think there was a second case in Minneapolis today. And I think Thursday, people started to think, well, maybe this isn't the end of the world. After all, the early reports are that symptoms from this particular variant are mild. And I think that there was, a rush to judgment in the beginning, and now there's kind of cooler heads prevailing at this point. But it just underscores perhaps how fragile confidence is and how shallow the investor pool is for hanging on when things get tough, right? That race for the exits on Wednesday was extraordinary. The Dow was up 500 points in the late morning. We got news that there had been a case of the new variant in California, and within 2 hours, the Dow was down 500. And that's not the sign of a market that is incredibly confident. Perhaps that is to be expected when you consider just how painful the 18 months were with shutdowns and no cruises and no airline travel and restaurants being shuttered and so forth. So I guess it's a natural reaction. But I do think between the symptoms being somewhat not benign, but limited at this point, and the confidence that Moderna and Pfizer have shown that they can get a vaccine out for this very quickly, I think that cooler heads can continue to prevail. At least I hope so.
Well, and then, so that was the Omicron, I think. I think you got Omicron and omni-channel confused a little bit, Martha, there in your pronunciation, an omni-channel virus. You also had Jay Powell removing the word transitory from his vocabulary, finally. After he finally got renominated to run the Fed, he came out and admitted that this inflation stuff is not transitory and that they may think about speeding up the taper. So I think there was an element of that as well, kind of lurking in the background. Although I think the panic on this variant thing was the biggest driver. But as we've continued to see throughout this whole entire last year and a half, is that none of these dips really last very long, right? I think there's just a lot of money on the side, a lot of money everywhere. And I think anybody who sees a 1 or 2% dip or a 3% dip, there's enough players on the other side. It might be a day or two later, but there's enough players out there that are dumping their money back into the market, kind of setting that floor.
Yeah, on the Powell comments, that just like the Wednesday Omicron news, it really rattled the markets. That was another case where the markets were generally rebounding from an earlier kind of sell-off due to the virus. Confidence was coming back. And then Powell did his testimony, and two things came out of that. One was that in December, there's a good chance that they accelerate the tapering, right? And a lot of people believe that once the tapering is done, then interest rate hikes will come immediately after that. If they went on that pace of 15 billion removed from the purchases per month, then the first rate hike was slated to be around July. But if they double that number, you're thinking rate hikes are going to come in March. So that really rattled the markets. And I'm not one to beat my chest, I have to say, but we did talk about this 2 weeks ago when we said that, Powell had been campaigning, if you will, for this job, and he had been really touting the White House line for a long period of time, staying dovish, pushing off rate hike talk, talking about inflation being transitory. And within a couple days of being renominated, here comes the new narrative, right? The new way of talking. And, we're going to be a little bit tougher. He didn't say this per se, but it was underneath the message on inflation. And there's more to it than we've been letting on. And I think that looking back, it does kind of make sense.
You're not really a beat your chest kind of guy, Menace. You're more of a bang your head against the wall kind of guy, I have to say.
Yeah, if I'm going to beat my chest, it's not going to be with my fists. I'm going to get one of those therabody things, the things that pulse. You see them all. You see them all the time. The Peloton instructor, Allie Love, is on all the commercials now, and she's shooting her arm, and they do that slow motion ripple of the bicep and tricep.
It's a weird visual. I got to move on.
It reminds me of when my most famous Yankee swap gift at the Trepp Christmas thing a couple of years ago was the shake weight. Remember the shake weight? It's like but anyway,
I think the Therabody will have as long a shelf life as the shake weight. That's my gut out of this. It'll be around for about 4 months, and then it'll be sitting on everybody's shelf, and it'll be a fad. But we do have one more thing hanging over the market, which everybody's watching, and that is hitting the debt ceiling once again. And we're at that brinkmanship level once more. There was supposed to be, the debt ceiling being hit by December 3rd. It's now been pushed out to about December 15th. The Fed says, Treasury says they'll have enough money until December 15th. But once again, we come up to this finish line that both parties are kind of circling each other in the ring, trying to figure out how much damage they can inflict on each other, while the rest of us kind of watch and figure out how's this all going to end, and what's it going to do to my portfolio when people start talking about Social Security checks and not being sent out and state parks being shuttered.
Once more unto the breach, dear friends. Meet the new boss, same as the old boss. I'm full of cliches today that are
and lyrics,
what you're
apparently.
saying.
There we go. Touting, or I should say quoting Roger Daltrey, is never a bad thing.
And Shakespeare.
You're a man for all seasons, Joe.
Correct.
Trepp released its monthly delinquency report, and we saw another improvement in the rate this past month behind the numbers.
So there's a lot going on in the delinquency report. We'll run through it. We released it today. I'll remind people that if you're not on our blog distribution list, you can join that for free. We do circulate things like our delinquency number via that channel every month, along with all kinds of interesting research. I think we put out something almost every single day that talks about macro and micro issues that are impacting the broader economy or commercial real estate in particular. In this particular case, the headline was that for the 17th consecutive month, the headline Trepp CMBS delinquency rate fell in November. The rate of decline dropped slightly from the October drop. The October drop had been the best improvement in 6 or 7 months. In November, the rate fell 23 basis points to 4.38%. That is the percentage of loans which are 30 or more days delinquent. In terms of loans that are in the grace period, we've been using this as a proxy for, how many loans and what percentage of loans could be looking at delinquency in the near term. 2.05% of loans used their grace period last month. That remains a pretty benign number. It was up 25 basis points from October. But anytime you're talking about a 2% handle, that's in line with what we've seen historically at times that have not been of a pandemic nature. Other interesting data points with this month's report: the percentage of loans with a special servicer fell about 23 basis points as well. It's now under 7%, 6.94% in November. For lodging loans, there was a decline of more than 100 basis points in November for loans in special servicing. For retail loans, a 63 basis point drop between October and November. And overall, the percentage of loans that are on servicer watch list declined by about 70 basis points. So a strong report top to bottom, big improvements in the levels of hotel and retail, the areas that were hardest hit during the pandemic. One more data point, which I'll throw in there. Our headline number includes loans that are from past the great financial crisis and a small trickle of loans that remain outstanding from before the financial crisis. Those diminish with each month, but that 4.38% number is an aggregate. If you look at just the percentage of loans after the great financial crisis, we fell below 4%. So really an ongoing healing of the market that is great to see, and it's really setting the tone for what could be a very nice 2022 for the market following what has been a really strong rebound this year.
So Manus, since you're being so positive today, I figured I should throw out some negatives. I was just looking through, because this number that we're talking about is the aggregate, like you said, and it's national, right? So we do break it down by property type and other things in the report, but I was just kind of out of curiosity pulling up a few things on Trepp, and for lodging across the top 25 MSAs by delinquency, there are still plenty of pockets of pretty serious distress, right? So, Portland, some of these numbers are, maybe due to smaller sample sizes, but not really. These are pretty large markets. So, the Portland MSA, 45% lodging delinquency, right? Houston, 45, Chicago, over 30, Minneapolis, over 30, Pittsburgh, over 30, right? Detroit, 23. And then after that, New York, Philly, Baltimore, it kind of goes down and down. Some of the best performing hotel markets right now: San Antonio, Denver, Miami, Phoenix, Tampa, Washington, DC, actually, Dallas, Charlotte. So not surprising there. If I do the same view on retail, the story's a little bit different, but some of the high numbers in retail, not nearly as high as lodging, but you've got Baltimore near 20%. And then everything else is, of the top 25 MSAs, is in the kind of 8 to 12 or 14% range. But, Charlotte, Atlanta, New York, Riverside, that's kind of there's not as clear of a pattern on the retail side. I think that's much more just about the loans themselves. But on the lodging side, you clearly see the differences between, northern, colder, lockdown areas versus places that people have been flocking for the last year and a half.
Yeah, I think that's true. I think that we've predicted it, and then we've seen it come true over the last 6 months, that the recovery in warmer drive-to destinations or family vacations, right, non-business oriented locations, would recover faster than business locations, conference centers, towns, and so forth. And I think that that's true. And I think that's underscored by your hotel numbers. I will throw in 2 more pieces of data here, which I neglected to put in before. The overall lodging delinquency rate now, 9.40%. So it fell below 10% this month, down 64 basis points. For those who have been listening for a long time, you'll recall that number peaked at about 25%. So we've seen a 60% improvement from the worst points of the delinquency readings for hotels. And we're going to give you several green shoots in a couple of minutes about hotels that talk about that a little bit more. On the retail side, a 30 basis point improvement in November. That rate now 8.09%. That was a peak of about 18%, if I remember correctly, at the worst moments of the summer of 2020.
So, Manus, this is not delinquency related, although I'm sure it drove a lot of the delinquency rates down. It's, we talk every week about just the abundance of capital in the capital markets and in commercial real estate, especially multifamily, industrial, those types of things. So I was just kind of snooping around Commercial Real Estate Direct, our sister company's news website. And yesterday they had a staff report, which was a lovely headline, in my opinion, which was domestic CMBS issuance is setting a post-GFC record. So since the great financial crisis, I mean, we had issuance levels of $240, $250 billion in 06 and 07, went to zero for a year or two, and it's been slowly making its way back up. 20, we came back down, but 21 has been just a banner year. And just a couple of high-level numbers here. So what CRE Direct calls private label issuance, they're only counting conduit and single asset, single borrower deals. There were 104 SASB, single asset, single borrower deals for about 75 billion so far this year. And that's about 3 times what we saw last year, a little bit less than double what we saw in 2019. But on the conduit side, which is what used to be the biggest part of the CMBS issuance market, we only had about little over 27 billion. So total, put these two things together, we're over 100 billion. And then we, on the Trepp side, we count CRE CLOs towards the total issuance number. And that number has been just off the charts, right? So I think in their story here, they have it at about 42 billion across 45 deals, which is about 1.5 times what it was last year and double 2019's volume. So put it all together and you're near 150 billion in total issuance, which is just, to me, it's bananas. It's a great sign for the market, I would say. And when you have this abundance of capital, I would say it forgives a lot of sins, probably, right?
Yeah, we talked about this with Orest Manzi a couple of weeks ago on one of those episodes. He is the editor of Commercial Real Estate Direct, and he collects a lot of the numbers that Joe was referring to just now. And one of the things we talked about was that even though issuance has really exploded, I don't feel, and I think I don't want to put words in his mouth, but I feel like he reiterated this as well, that the higher issuance volume has not come by virtue of diminishing standards of lending, right? In 2006 and 2007, what we saw was pro forma lending, right? Lending on future business plan execution, whether that meant turning a rent stabilized apartment into market rents or flipping office tenants from $40 a square foot to $100 a square foot, letting borrowers lever up to 98%, only having 2 or 3 percentage points of equity in the game, right? That's how CMBS exploded in market share in 2006 and 2007. Here, whatever market share CMBS is gaining feels more sustainable, right? Some of our listeners will come back to us and say, yeah, but the CRE CLO stuff, the first time we see a downturn, a lot of this stuff will be handed back. The guys will run out of cash. They will not be able to finish their business plan. Perhaps that's true, but it doesn't feel as built on sand as what we saw in 2007.
Yeah, I'd also say that if you dig into some of this stuff, I mean, just the idea that 75% of it is SASB. Well, 75% of the 100 and so billion, not counting CLOs, single asset, single borrower, those are usually to larger, more institutional grade borrowers, right? And then we did have some massive SASB deals, especially from Blackstone, right? Like Blackstone industrial portfolios and some other portfolio SASB deals that they did this year. So you do get a lot of volume from a smaller amount of, I guess you could call more high quality sponsors, as opposed to back in the day where, you'd have a $7 billion conduit deal to 200 borrowers, right? And it could be the guy who owns, I shouldn't say strip mall, the guy who owns the retail center and like 3 other properties, right?
You'll have to think that part of that CRE CLO space, as our colleague Darren King mentioned several months ago, is coming from people that would normally use the CMBS conduit market. So some of the depression in that CMBS conduit space and some of that expansion of CRE CLO may be coming because people want to keep their options open in terms of being able to prepay this freely sooner rather than later and refinance into something longer term once they can get more proceeds. But that remains to be seen.
Yeah, so I don't want to belabor all this too much. I got to give Orest another shout out here because they had another story a couple of days ago about So on the other side of things, I mean, actually that's relatively connected to series CLOs, but it was alternative lenders origination volumes bounce back to pre-COVID levels. It's kind of about that time of year when you start doing like full year totals and league tables and stuff. So it makes sense that these stories are there. But this was, according to MBA, the Mortgage Bankers Association, they reported a 234% increase in lending activity among quote unquote investor driven lenders so far this year. So that's mortgage REITs mostly. The top lenders here, mortgage REIT originations, this was as of Q3 21, I believe. Blackstone, Starwood, Apollo, KKR, TPG, Granite, Benefit Street, which is now under Franklin Templeton, Ladder Capital, and a few others. And these are the same lenders that are powering the CRE CLO market as well, right? For simple numbers, if they originate $10 billion or $5 billion, they're probably putting a quarter or a third of it into CRE CLOs, and they're financing the rest through bank warehouse lines and with equity. So, it's a virtuous circle, this whole thing, right? There's investors plowing capital into this space, and then those firms putting that capital to work, and then kind of securitizing a lot of the debt and kind of recycling capital over and over. And that's all well and good as long as we're all kind of keeping an eye on each other. The last thing I'll say is a lot of the CRE CLOs or a lot of the volume of it is in multifamily, which, the thesis on multifamily is still strong, even though there probably are some stories or some loans or some underwriting that's a little bit optimistic.
Diving into hotels, we saw this week the news that hotel performance over the Thanksgiving holiday was the highest compared to any Thanksgiving on record. So occupancy was 4.3% higher than 2019 levels, which is obviously a very positive story according to our friends at STR.
I have a thesis on this. I just came up with it because when you told me these numbers before, I was like, kind of like, really? It's kind of surprising. My thesis is people wanted to get back together, obviously, for Thanksgiving, because they probably weren't together last year at all, but they didn't really want to stay at each other's houses. Right. So maybe back in the day, you used to go down to your uncle's house or your sister's house or whatever it is, and you'd stay over. Now it's like, let's go, but let's like kind of be a little bit distant. Then I'm going to go back to the hotel. And also I have social anxiety because I haven't hung out with real humans in a year and a half. So I'm going to like bounce out of the Thanksgiving dinner and go to the hotel by myself. That's my psychological thesis.
That's a valid. I actually thought about that. We're also seeing some serious green shoots in this space, Manus. Your theme for this week in hotels is we've got some big cures.
Yes, after 2 weeks of really doing deep dives into retail, today's deep dive will be into the hotel market. And what I was trying to get my arms around when looking at the data, we talked about the 64 basis point drop in hotel delinquencies. Was that real, or was that, just some kind of other factor that other than cures and recoveries that might have been influencing the data? A quick educational segment. There's 3 things that can influence your delinquency rate. Number 1 is new issuance, right? If you're exploding in new issuance, that increases your denominator, and it will reduce as a percentage of your pool, the percentage of loans that are delinquent. When we produce our headline number, we wait for 6 months before a new deal is seasoned, before it comes into our calculation. If you added the deal immediately, you'd be adding in right away $1 billion of performing loans every time that you added a new deal. So we wait 6 months. But why is there not a denominator effect for hotels? Well, there's no denominator effect because there hasn't been a lot of hotel lending in CMBS, right? So the denominator hasn't grown very much. Another way delinquencies can fall is you take some of the old or more troubled loans and you get rid of them. You sell off a property via REO, or you sell a note that is troubled, a delinquent loan, and that reduces the numerator of bad hotel debt. And that could drive your delinquency number lower. In fact, from 2010 to 2012, that was a big driver of the reduction in delinquency rates. It wasn't that things were curing, it was that special servicers were getting rid of lousy assets. In this particular case, what we have found is there were an awful lot of cures over the last month that really helped depress that hotel rate. And I'll run through a couple of them very quickly just to underscore, that's a word I'm using a lot today, underscore, make it a college drinking game at some of those programs that have great commercial real estate programs, Dave Hartzell's UNC Tar Heels and
Lonnie Hendry's students. I'm sure he's forcing them to listen every week.
Tim Ridio's group in Wisconsin, right? That's everybody hanging out at State Street at the local pub, listening to our podcast and tipping back 8 ounces every time we use the word underscore. Anyway, going back to what we saw, one of our headline stories this week in our TreppWire, a big CMBX 7 Chicago hotel loan cured. This is $97 million of debt on the Marriott Chicago River North Hotel. Special servicer notes indicated that the borrower had executed a reinstatement agreement. This is a huge turnaround for the loan. As of October, the paid through date on this loan had been April of 2020. So no payments for 18 months. With the November servicer data, the paid to date advanced to October 2021. The property is a 523 key full service hotel on Dearborn Street in Chicago. We wrote about this in June 2021. At the time, the value of the hotel had been cut from 191 million in 2013 to 84 million in 2021. So you could have looked at this as a dead loan walking, right? No payments for 18 months, negative equity. Chicago, as we've said before, and Joe reiterated at the top of the broadcast, kind of a lot of pain in the hotel market there. And here is something that has cured, right? Something that I think you never would have expected, or you certainly wouldn't have bet on 3 or 4 months ago. And yet the borrower has come through and said, we're going to, continue to support this thing. A terrific piece of news for everybody, except for the CMBX shorts. We'll get into that a little bit more.
So Manus, the impressive part about this not only is the cure itself, but also the fact that bringing this loan current, I didn't do the math or look at it, but it would have required a lot of cash, right? So this is the borrower kind of reinstating their confidence in this particular asset / this market, right?
Right. I mean, if you miss 18 months worth of interest payments, assuming you were paying 5% on $100 million, right? As you mentioned, Joe, you're talking about 18 months, 7 or 8%, plus whatever you may have to come up with in terms of principal amortization and replenishment of reserves. It's possible the borrowers were looking at $12 or $15 million to reinstate this particular thing. And, if we were talking about a property in Las Vegas or Phoenix or Southern California, right, where confidence has never really waned to the point that it did in Chicago, this wouldn't be as surprising. But in Chicago, this is a real turning of the weather vane, if you will. I'll throw out a couple more things. This is split across 2 2013 CMBX 7 deals. One of the deals, the loan piece represents almost 6% of the collateral. And in the other deal, it represents almost 8% of the collateral. So I mentioned a minute or two ago, this is great news for hoteliers, great news for CMBS cash investors, not so good for CMBX 7 shorts, right? CMBX 7 shorts, their thesis had been retail is going to blow up. When pandemic began, retail is going to blow up faster, sooner, and more painfully. And the gravy will be hotels are going to blow up too. Now what we're seeing on both CMBX 6 and CMBX 7 debt is the retail loans are extending often, not always, but often, and the hotel loans are curing. I'll let Joe throw in his 2 cents, and then I'm going to throw in 4 other cures that caught my eye this month.
Show me how you do that trick. The one that makes me laugh. The one that makes me scream.
Why are you singing The Cure right now?
It's all I can think of because you keep saying Cure, and that's like, I love that song.
Is that from Friday? I'm in
Actually,
love.
a good song.
Show me, show me, show
Robert
me.
Smith,
how
weirdest
you do
guy,
that
but good group.
Anyway,
On
that's
Friday, I'm in love because I love Fridays. Thursday night is my Friday night because I've finished my Trepp podcast, which we prepare for a considerable period of time during the week.
yeah,
And
like
I've
6 or
written my
7 minutes.
I've written my last TreppWire for the week until Sunday night. So I feel good on
Well,
Thursday night. I don't
let me
always
just
feel good on Friday
throw
morning.
let me just throw out the excuse for my punchiness is that I'm actually in the office, and so that means I got up 2 hours earlier, and I've been, can't walk downstairs and like walk outside of the back porch for 10 minutes and get your brain back together. So it's going to be a late one tonight in the office, but at least we won't be. Well, I'll be elbowing a few fewer tourists in Rock Center tonight versus last night.
There we go. All right, a couple of other cures that we saw this month. I'll run through them quickly. The Hilton Richmond Hotel and Spa, that's a almost $40 million loan, 5% of another CMBX 7 deal. The receiver there was dismissed and the loan is in the process of being reinstated. Why does this matter to me? For the 12 months ending in June 2021, DSCR at the property was 0.71x. So another vote of confidence by the borrower here. The Marriott downtown Orlando, a 296 unit full service hotel. It also cured. Does that mean a lot to me? Not a whole lot. I'm wondering why that Orlando hotel was ever so distressed to begin with, but it's back to current again. Two other ones that were, like Chicago, beat up parts of the market. The Hotel Giraffe, 365 Park Avenue South. That backs a 2015 deal, $32 million worth of debt, a 72 unit full service hotel. That loan cured. Again, Manhattan, we've talked about before, not that unlike Chicago, terrible market, lots of hotels closed, no business travel, miserable occupancy. Again, here a borrower taking a chance that they could figure this thing out with a Hotel Giraffe. And a hotel loan, the Sheraton Dallas Fort Worth, 3% of a 2017 deal, a 300 unit full service, a 300 key full service airport hotel with a $32 million loan balance. That too cured this month. So in each one of these cases, these went from 90 or more days delinquent back to current. Cue up the applause.
Turning to office, we saw a story this week that pedestrian traffic's coming back slowly. Foot traffic is only down about 38% from 2019 levels in the month of October. And that's impacting local businesses. Traffic is helping during the week where people are coming to work. On the weekend, it's a little weaker. So that's a good news, maybe.
Well, I think if I'm reading this correctly, we're 38.1% below 2019 levels. Is that right?
Yes, it was it was down 44+% a couple months ago.
So this, to me, it's a green shoot, to use Manis's terminology, if I shall be so plucky, because most of the time we're reading these numbers, and when I see 38.1%, I think that's the percentage of pre-COVID levels that are back. But it's actually, what does that mean? 62% are back, or at least somewhat back. So that's a pretty
walking around. It's a walk. It's a
number.
pedestrian measure. So it's not office occupancy. So you have to, distinguish office occupancy is what it's, been slowly coming back to. This is people walking around, and that's important because they're the ones that go to restaurants, they go to stores, they buy coffee.
Yeah, I don't know. I think some of this might be tough because I feel like I care a little bit more about the office swipes because that's the biggest driver. And I think some of this could be, there's tons of young people moving back to Manhattan over the last 6 months or 12 months, and they're all going out and about and hanging out with their friends, but not back at the office. So I guess good for some real estate, multifamily apartments, and, some of that street level retail in those areas. But I can tell you that, Midtown's still pretty light, a lot better than it was before, but still pretty light, despite we are seeing a lot of tourists at Rock Center, which is, I guess, good to see.
I will give a potpourri of office headlines for this week, but first I'll throw in my 2 cents about Manhattan. I was actually there about a week ago. I was home in New York for Thanksgiving break and got to hang out with one of my daughters who was looking for a new apartment. And inventory on the apartment side is quite limited, right? Not a lot of inventory there that's affordable and livable, right? A lot of older supply, highly priced. You're not going to get probably anything under $2,500 a month with a doorman. And that's for a 1-bedroom for those who are not in New York. I mean, or maybe even a studio. It's kind of through the roof in terms of what people will pay for this. My other observation when we were looking for places was retail, street level retail in New York is just a mess. It really felt like half of all the stores on any given avenue, which is where most of the street level retail resides, was closed, right? Closed restaurants, closed coffee shops, closed dry cleaners. It was really one after another, regardless of neighborhood, right? Whether you were in a neighborhood that was heavily residential or if you were in more of an officey type of neighborhood like Midtown, it was a bleak look at the moment. A lot of those storefronts with kind of the washed out white stuff over it and not allowing you to peek in.
Either that or my favorite is on Madison Avenue. We have one of those stores with just a bunch of folding tables with like shoes and shirts and 80% off signs everywhere, like where probably there used to be a Cartier or something very, very fancy. I will give, I'm like going heavy on CRE Direct today, I think, just because I was really reading a lot today on there. I'll give our friends at Signature Bank a shout out. Actually, I guess a relatively more positive story here and this is kind of on Fifth Avenue, so in Midtown. So they lent $125 million to a fund to fund the purchase of 59,000 square feet of retail space at 530 Fifth Avenue. That's in Midtown, I think between 44th and 45th on Fifth Ave. And that's the bottom 2 floors of a larger office building. The thing about this is that it's fully leased out to Dwayne Reed, JP Morgan, UGG, and Five Below. So it's not one of those empty storefronts, and it has some pretty strong tenants there. But I thought that was a nice little green shoot story for the high street retail world down here in Midtown Manhattan, where otherwise we're seeing a lot of empty windows.
Going to a couple of other headlines we watched this week. For the most part, it felt like the rich getting richer. This first story is from the Biz Journals of Charlotte. The Lowe's Global Technology Center sold to Apollo Global Management for $318 million. That represented a price of almost $900 a square foot. It obliterated the previous sales record for a Chicago office building in terms of price per square foot. The one thing we were concerned about in the Charlotte area was perhaps overbuilding. There was a lot of new supply coming on there, but if you have a strong tenant with a long-term lease, it's almost like you can name your price these days in terms of what you can attract. And that was the case here with that sale of the Lowe's Global Technology Center. 2 other stories that both touch the same firm. Meta, which we all know was formerly Facebook.
Does that run our test?
Right.
Oh, no, sorry.
They signed 2 leases. The first one was in Sunnyvale. They took on 700,000 square feet of space from Tishman Speyer. Tishman Speyer bought this property, I think, less than a year ago. It used to be the headquarters for NetApp, and Facebook will now be taking 100% of the space in that property. Why does that matter? Well, it really doesn't, because that market is so hot. Sunnyvale has already filled up the Moffett Towers with the likes of Apple and Google out there with hundreds of thousands of square feet. If Facebook didn't take it from Tishman Speyer, some other unicorn would have. So it's not huge news for that market. Somebody was going to take that space, but they also got together those two firms, Tishman Speyer and Facebook, where Facebook took another 500,000 square feet in Burlingame on Airport Boulevard. Both of those stories were from siliconvalley.com, and you could check out that website to see both of those. In the "this feels good" category, those first two, the Charlotte one and the California ones, those were kind of a little bit yawn-inducing because those were great markets. In Stamford, Connecticut, the Digital Currency Group signed on for almost 100,000 square feet. This comes from Real Estate Business Online. Why does this matter to me? Well, Stanford has seen a ton of pain, or did see a ton of pain from 2008 to 2015, and they still have a couple of assets out there which are really troubled. One was occupied by opioid maker, the Sackler family, Purdue Pharma, and another one that saw a few vacancies recently, lease terminations. So anything in Stamford, Connecticut, where they're really building back that tenant base is a green shoot for me. I root for those cities that have run aground in recent years.
Manus, let me give you the segue of the century here. Speaking of digital currencies, did you see that story about the Meta land sale?
Well, it's a segue of all time. You're pulling in together digital currency and Meta, which is formerly Facebook, into a story that says a digital plot of land was sold for $2.43 million, which this comes from Business Insider. That's a price that is above what people pay for real acreage in San Francisco or in New York City. Go figure. Joe, you're one of these guys, man. You're buying Bitcoin out of vending machines. You walk around with those earless headphones.
Earless headphones.
AirPods.
You use Spotify. You no longer use vinyl. Tell me about this. Are you on the Metaverse yet?
I think you're being a little tongue in cheek now, because I think you understand that I am about 34 years older than my actual age in my brain. But funny story about this one. First of all, by the way, you mentioned the vending machine. I was in a gas station in Greenberg off the Sprain getting a bag of chips, and they had a Bitcoin vending machine. I'm like, what is this? Anyway, this was a plot of land in a place, if you can call it that, called Decentraland. And I have to give a shout out to our old friend Andy L, because I was talking to him about 9 months ago, and he is a cryptomaniac, and he let me know. He said, Joe, Mana, MANA, buy Mana. That's the currency used in Decentraland. So I bought a little bit, and then I sold most of it, and I still had a little bit left over. And since Facebook has made this announcement, this digital currency is up 15x. So it's a win, but it's also a stake right in the heart, because it could have been a much larger win. And I'm not a crypto guy, so please don't paint me with that brush. But I did hear on another podcast that the people who are buying this quote unquote plot of land plan to quote unquote build property there and then rent it out. To whom and for what? I don't know, but good for them. Thank you, Jerome Powell, for all this money.
This sounds like a kind of an online game of Monopoly, which I never liked as a kid. I never liked it as an adult.
It's Sim City plus The Sims.
Sim City.
I mean, I never liked
real money. World of Warcraft, I guess. I mean, that's. But
Monopoly,
anyway.
where somebody lands on Park Place and you charge them rent and you build a house on there, and I don't get it. You told me a couple of weeks ago, Joe, that I could dunk in the Metaverse if I ever got in there, but everybody can dunk in the Metaverse. What's the fun of that?
That's right. It's like Incredibles when the son says, "If everybody's super, then nobody's super." So I did also hear that there were some ideas about like law firms buying space in these like quote unquote law offices, and then they could host their clients in these virtual spaces and all this other stuff. And it got me to thinking that there are a few things I might rather do in the Metaverse, like go to the dentist, right? Or maybe some other more invasive medical procedures that might be better digitally than, analog. So we'll see how that goes.
Our commercial mortgage investment index called Life Comps was released this past week. Joe, walk us through what it shows us.
Yeah, real quick, high level. Go download the report, please, trepp.com, or shoot us an email, podcast@trepp.com. This is for all of you balance sheet lenders out there, especially the insurance company side. This is an index that we track on a quarterly basis based on real insurance company loan performance. And a lot of insurance companies use it to benchmark their performance against their peers. Hard to really find a lot of excitement in these quarter over quarter numbers because it's really plodding along. You get a little bit of price appreciation or a little bit of price depreciation, and then you get interest return. But last quarter, we were almost at negative 1% total return. And this quarter, we're back in the positive territory, about 1.22%. Most of that coming from income, about 100 basis points coming from income, another 21 basis points coming from appreciation. And I guess one highlight here is that a big portion of that return actually came from the hotel loans in the underlying index. They drove the biggest portion of the return in terms of property types, with retail and industrial second and third. But it kind of aligns with a lot of the other cure stuff we were talking about before, which is the lodging and retail took a hit, but they're also the ones kind of that have big chunks to recover. So we'll see those recoveries in the quarterly numbers.
And some shout outs, Shlomo C, Andy W, Bob P, and a programming note. We, the podcast team that is, will be in Miami, January 9th through the 11th at the Lowe's. And if you want more details about that so that you can meet up with us, possibly even be recorded for some segment or shout out, send us an email and we'll give you all the details about that.
I have to say, Shlomo C, I met him several years ago, actually a long time ago. We did a little panel together somewhere, I forget. And I don't know if he still does this, but he hands out, his business card is a $1 bill, like a real $1 bill. And he hands them out, and it's got like a little holder with his name and his contact and a dollar bill in it. I love that guy. He knows how to do really good marketing. And so anyway.
Is it true you tried to meet him every day for about 4 years?
Yeah. I kept putting on like the Bobby Bonilla or the Bobby Valentine mustache and glasses to go back and meet him and get another $1.
Anything for $1. Listen, I will throw this out there. This Miami thing, I have been pushing for Martha, Joe, and I to do a poolside, and Haley, to do a poolside live pod. And if you are out there and you are going to be in the Miami area because either you do business there or you are going to the same conference we are, and you'd like to join us for a mojito, feet in the pool, feet in the baby pool, making splashy noises and talking CRE, please let us know, because we'd love to make this an interactive type of thing, and you'll get to see Joe with his floaties on.
Yeah, and if you want to if it would be so good of you to just lug any podcast recording equipment over for us, that would also be great.
Yeah. We just wanted you to meet the team. Manis wants us to sit in the pool and plug in our microphones.
Can't you picture Martha with that mojito in hand, that movie star look with the big, sunglasses and